So here's how you should reduce your taxes if you're a high W-2 income earner. The obvious is to max out your 401k. I wouldn't be a tax strategist if I didn't tell you to do that. But the second thing you should be focused on every single year is acquiring one short-term rental property. If you can acquire one short-term rental property and rent the property on average 7 days or less per customer, you can activate losses on the tax return. So now we should end up performing what's called a cost segregation study. This is the strategy you're gonna use once you acquire the short-term rental. And this is gonna give you anywhere between 20 to 30% of your purchase price as a year one tax write-off. So let me give you an example. If I buy an investment property, one short-term rental at $500,000, I'm getting 20%, so that's $100,000 in year one depreciation. If I'm earning $100,000 as a W-2 taxpayer and I have a $100,000 loss, I'm paying zero taxes. And this is why W-2 taxpayers should focus on short-term rentals in combination with their retirement.
Great advice here, and I think this does apply to a lot of W-2 earners. The caveat that is probably not mentioned is there is a limit on as a W-2 earner on how much you can deduct against your W-2 income. For many people, it might be sufficiently fine. For singles, it's going to be $315,000. For married couples, it's going to be $630,000. But once you start reaching higher and higher levels of income as a W-2 earner, for example, $1 million or more, you're going to want to apply other strategies as well on top of this if that was your primary vehicle of trying to reduce your taxes.